Hey there, everyone. Dave Keller here with Market Misbehavior. As you may have heard, I'm out on vacation the next couple weeks, going to Iceland with my family, so I won't be around to do a daily market recap show. In lieu of that, I thought it'd be fun to revisit some sort of timeless investment wisdom. This week, we're going to be talking about the 4 deadly sins for investors. This is based on a series of exercises I've done with successful investors over the years, trying to help them sort of focus in on which areas of their investment process, are in great shape, and then which areas of their investment process probably could use more time and attention. And I think as we go through these 4 deadly sins through the course of the week, and if you watch every day, you'll get one every day. Hopefully it gets you to just think about how you think about your process, right? Sort of, focus in on maybe the 1 or 2 of these that you really resonate with, or that really resonates with you. And hopefully that gives you some things to think about as we get into the school year as areas of opportunity. So to just set the table for this meal we're going to have together this week, I wanted to start with just comments about a conversation with my son that I had a little while ago. My son's big into soccer, and as you probably know, we're based in the Pacific Northwest. I always report on the weather from Redmond, Washington, at the beginning of Market Recap Show. That's because we're based outside of the Seattle area. And so, if you've been to this area of the country, it's a beautiful, beautiful area with a lot of mountains and water and hiking, a lot of outdoor activities. There's some pretty decently nice people. We're also big into soccer. Certainly in my family, we're big supporters of the Seattle Sounders. This is in happier times when they were playing a lot better and didn't have so many injuries. It's been a tough 2026 season, to be honest. But this was about 2 seasons ago when they made it through the first round of the MLS playoffs. They won in a shootout. My son and I went to the match, and this is right after they had a shootout victory to win the match. It was super exciting. We were pretty cranked up about it. But earlier, as we were talking about the game, Henry, my son, was a little quiet, and I was like, "Dude, what's going on?" And he said, "I'm worried about my game this weekend." He had a match coming up that weekend, and again, he's plays club soccer, so against the different clubs in the Pacific Northwest at this point. And he was, he was really worried about the match coming up. So I said, "All right, well, what are you worried about? Like, tell me about it." And he said, "Well, what about the ref? Like the ref, the last game was calling things really tight, and so it was really tough to figure out, to kind of guard people well and stuff." And I was like, "All right." And then he said, "And then the other team's really good, and they've got a couple really good players that I remember from last time we played them, and they really, got behind our defense and something." I was like, "Okay." And he said, "And the weather, of course, in this part of the country is pretty volatile at times, and often wet and a little bit cold because they play through the winter. So it's, maybe it's rainy, maybe the ball's slippery, the conditions might not be great." And so he's sort of listing out all these things. And so I sort of stopped for a second. I said, "Dude, you were worrying about all these things that you can do nothing about. So listen, stop spending your time worrying about things that are out of your control, and let's focus our time on things that are in our control." So we talked about what are the things that he could actually do between that moment and his game that weekend to give them the best opportunity for success. And it was like, all right, I can, think about how I prepare over the next couple days, how I'm spending my practice time, talk about communication with my teammates. How can I make sure I'm communicating clearly? How can I make sure that I have good situational awareness on the pitch and make sure that I know where I need to be at any given point? Can I talk to the coach about some things that I struggled with that, maybe he can give me some pointers about how to better address some of those challenges? What can I eat, to make sure that I have good nutrition? Can I make sure I get enough sleep so that I'm mentally prepared for it? So he came up with this list of things that were very much in his control that he could have direct impact on. And by realizing that empowering feeling of recognizing that there were actually things he could do to make it better, he was in a much better place through the week going into that match. And I would say for investors, we have the exact same issue. We spend an inordinate amount of time worrying about what the Fed's going to do, what the market's going to do, what key stocks are going to do, what news comes out, events from the Middle East, geopolitical events, elections, all these things are very much out of our control, right? There's not much we can do to move the needle on any of those things. So what are those things that are in our control? how we spend our time, what we read, what we watch, what we listen to, what we do with that information, how we gather evidence, how we develop a weight of the evidence approach to make better decisions, how we review our decisions and evaluate successes and dig into some of our failures and see what we can learn from them. I have come to believe that investors get into trouble because they focus too much of their time on the things that we really can't do anything about and not enough of the time on their systems, their routines, their processes, essentially how they spend their time as investors. So this particular sort of mini series we're going to be doing this week comes from an exercise I used to do with portfolio managers when I would meet with them for the first time. Someone would get like a new fund assignment, and I would often try to meet with them early on to just talk about their approach and think about how, my technical research team could help them make better decisions and hopefully manage risk and generate good ideas, all those things they're trying to do, and how we could support them. So one of the exercises we would do is I would take a notepad and I would just sort of draw out this sort of idealized, pattern on the page. And I would say, listen, I'm going to show you a couple different, potential buy points. You tell me which one resonates the most with you. Like which one is sort of your classic buy idea, right? So category one would be, a stock in a downtrend. These are sort of the deep value contrarian types of investors. I'm looking to buy things when it's going down, when it's completely out of favor, when no one thinks it's going to go up again. That's when I want to start nibbling on a new name. Category two would be sort of the emerging strength investors, right? Investors that look for things that have been beaten down for quite some time but are just starting to improve, right? Stocks that were showing signs of accumulation after a long period of distribution. So a little more patient, a little more conservative than the first group, and maybe just looking for, new ideas based on stocks showing new uptrend characteristics. The third bucket would be breakout investors, right? Kind of classic growth investors, momentum investors. I'm looking for stocks in new uptrends. I'm looking for stocks that are established. I'm looking for things just breaking above a key resistance level, maybe breaking out of a base. And I'm looking for stocks emerging after a sideways period of consolidation. Then the final bucket would be pullback investors. I'm looking to buy the dips. I'm looking for stocks that are in strong uptrends, and I'm just looking to buy the short-term pullbacks, buy the short-term weakness. So what's interesting is in some ways, they're probably each of those are names that you may have bought in your own account, right? When you think about your own trading approach, but probably one of these is sort of your ideal chart. And that's what I would always ask people, like, show me your ideal chart. Show me your best trade over the last 6 months so we can dig into how we do more of those things going forward and how we can help surface names in that particular bucket. So I would encourage you to spend some time going through this exercise on your own and think about which of these, sort of ideal entry points lines up with how you're trying to play this game, because there are certain technical analysis tools that can really, help us, maximize our gains and minimize our losses based on one of those different entry points. But in going through those entry points with a lot of people, we would often talk about what would get in their way, right? What would prevent them from making those good buy decisions or sell decisions. And so I kind of developed this paradigm of the 4 deadly sins for investors. And you'll probably very quickly figure out what the 4 deadly sins are, because the first one is buying too early, right? In that first bucket, we talked about investors buying beaten down names, buying stocks that were in significant downtrend, stocks that were very much out of favor, kind of the classic value methodology. The problem when you buy too early into those types of names is the stock or ETF just continues to go lower. And I will ask you, can you think of a time when you bought a stock that was down, you felt like you were getting in at a really good price, but then just sat there as you just started your trade with a bunch of losses as the price continued to go down? And clearly that was not the right time to get into that particular stock. I won't ask you to raise your hand, but I can feel on the other side of the camera that you're there raising your hand wherever you're watching this. So for each of these, by the way, through this week, I'll share with you what the bias is, what causes us, or what the sin is, what behavioral bias causes us to make that mistake, and then a technical analysis tool we can use to try to address that issue in our trading. So if you're buying too early, if you're buying things that are down and then just watching them go down even further, there's 2 biases that come to mind in there. The one is pretty intuitive. It's the falling knife bias, which is a common, emerging bias, I would say, in the behavioral finance literature, sort of acknowledging that we love to buy things that are down a lot just for that reason, right? This idea that just because something is down a ton, it means it's a great idea. Now, the reality is, if you look at market history, traditionally buying things and buying equities that are down a lot generally has been pretty good, right? When you've bought the S&P 500 every time it's down 20 to 30%, overall, you've done well on pretty much all of those trades, depending on how long you've held it, right? Because the market's recovered from 100% of previous market correction periods, right? The market's always eventually made new highs, sometimes sooner rather than later, but eventually it's always recovered. So falling knife bias is tough because in the short term, we're buying and then we see further losses. So the falling knife bias is one, which is basically just buying something that's down a lot just because it's down a lot. And I was taught price always goes down for a reason. I was always taught don't confuse the bottom of the page with support. Just because something's down a lot does not necessarily mean it's a great idea. The other one is overconfidence, right? Sort of our overconfidence in our ability to bottom pick and our ability to have these perfect buy points. And there's another one called hindsight bias, where we often have really positive recollections of our ability to buy previous lows. And as time goes on, our own assessments of our trading performance gets better and better, which is kind of a funny one. So falling knife bias, we buy things that are down a lot. Overconfidence, we just believe that we can do it, and then just causes us to take outsized risk in a stock that's probably not in a good place. So how do we get around this? A couple thoughts that I would say, and the most important one is to follow the phases. The way that I think of investing, and if you've watched the Market Recap show, we often refer back to what phase that the chart is in, right? At any point, a stock or an ETF can be going up, it can be going down, it can be going sideways. It can be going up, meaning an accumulation phase. And this is my language and vernacular that I've developed to describe these different phases. An accumulation phase, for me, is a pattern of higher highs and higher lows. This is an established uptrend, recognizing that investors are buying in on short-term weakness and continuing to push the price kind of onward and ever upward. Price is usually above upward sloping moving averages, as we can see from this example of Target from early February 2026. A distribution phase is a downtrend. This is when a stock is making lower lows and lower highs. This is when the trend is down. This is when the price is below the moving averages that are all sloping downwards. So that's a distribution phase. Third one would be a consolidation phase, which is more of a sideways phase. Arguably, the S&P 500 recently kind of settling into that consolidation phase between around 7,300 and 7,600. Just recently, here going into August, breaking above 7,600 for the first time. So that was a chart in a consolidation phase until it broke out, and I would argue signaling a new accumulation phase. So I would say a first sort of initial thought is to always start your analysis of a chart by defining the trend, by defining what I would call the phase, right? So are we in an uptrend or a downtrend or a sideways trend? And until we define that right up front, we're really not very well equipped to do any further analysis on the chart, because that has to sort of set the stage for our analysis. So on this chart of Target at this particular time, I would argue we're in a new accumulation phase. And what makes me think that that's true, because we're making higher highs and higher lows. We're above all the moving averages. We've broken back above the 200-day. The momentum has gotten stronger. All of those things suggest we're in a new sort of accumulation phase. So if you find that you're buying too early too much, what that probably means is you're spending too much of your time looking at charts that are in clear distribution phases. So what we want to start to do is sort of push our entry point back a little bit, or push it forward a little bit, right? So we want to look instead for stocks that are in consolidation phases. Maybe we wait for the stock to actually establish some sort of base. Maybe we wait for a low to be established and then for that low to be retested. And then maybe using those new lows as an entry point gives us further validation that we're no longer in a distribution phase. We're now holding support, which means now I can buy at a level that I have a reasonable expectation could be an important low that I can bet on. Or maybe we want to be even more, conservative and wait for an accumulation phase, right? Wait for the stock to actually bottom out and wait for that improvement. So on that initial drawing that we had back here, we maybe move our buy point from this point to over here, right? And wait for, look for stocks that are in downtrends, but instead of just buying those names because they're down a lot, we put them on a watch list. Then we review that watch list regularly to look for charts that are starting to break higher. And what are some of the technical indicators we can use to look for that rotation higher? Moving averages are obviously one of those. So instead of being below all the moving averages, we start to trade back above them. That's one thing. The RSI stops being oversold or maybe comes above that oversold region, maybe pushes above 60 on a rally, which would tell us we're in a new, maybe a new accumulation phase. The MACD or PPO indicators are pretty awesome because they are designed to signal when a trend has started to reverse. And when the MACD line crosses up through the signal line, that's a great indication of a trend that's reversed from a downtrend to an uptrend. And the chart of gold, I would argue, and this is the GLD that I'm showing here, just recently arguably went through all of those transitions that we just talked about. This is another great example to sort of think through, right? So if you're buying the falling knife, that means you're probably buying during these sorts of periods when the chart is still very much in a distribution phase. And again, what makes it a distribution phase? We're below the moving averages that are sloping downwards, particularly here, the 21-day EMA and the 50-day simple moving average, both sloping down during that period. The RSI is usually mostly below 50, which tells us we're in a period of negative momentum, not positive momentum. Then you can see in late June, and then all through July, look how we start to find support right around 365 on the GLD. We're not making new lows anymore. We're actually making fairly stable lows. So just like the chart of Target, the previous chart, we've sort of hit a floor, and then we continue to bounce off that level. That's a great sign that maybe we're no longer in a distribution phase. Maybe there, I take an initial position or I add it to a watch list. There's also a bullish momentum divergence on the GLD in June going into that eventual low in 365. So going into that low, we're actually doing it on higher momentum, on momentum that's actually trending higher. Then again, the more conservative approach, wait for an upside reversal. By now, the GLD has broken above key trendline resistance. It's broken above the 50-day. The RSI is breaking above 50, now above 60. All these things are starting to change. Now, is this a clear accumulation phase? Maybe, maybe not. I would say getting above the 200-day moving average would certainly validate that. But is it no longer in a distribution phase? I would argue probably yes. Have we seen signs of a rotation? So if I'm too often buying the falling knife, does this give me some ideas about how to wait a little more tactically for stocks that are either bottoming out or rotating higher? Perhaps. So there we go. That's the first of the 4 deadly sins for investors. This one is the challenge of buying too early. And if this happens to you, you're probably falling victim to the falling knife bias, maybe overconfidence. Maybe it worked once and now you're trying to replicate that perfection of buying the low and feeling like a rock star trading genius. I have found in my own experience that waiting for signs of stability, waiting for that consolidation phase, even waiting for a new accumulation phase, watching those indicators rotate, at least in the short term in a more bullish position, gives me a much higher percentage rate, a much higher hit rate, and much greater confidence that the chart that I'm buying is probably going to go further up from there. Stay tuned for the other 3 deadly sins for investors. And again, I hope this week makes you think about how you think about your trading. For Market Misbehavior, my name's Dave Keller. Have a great week, and remember, it's always a good time to own good charts. Take care, folks.